How's it going, everyone? Today we'll be going over the equity method within accounting, which is just a method a parent company would use to account for its investment within another company. So whether you're studying for the FAR CPA exam or you're in an intermediate accounting class, then this is definitely the video for you. Now within this video, I'll just be giving a broad overview of the equity method and then going over some examples involving the equity method. So if you just want to skip straight to those examples, then I'll leave a timestamp below for you. That being said, let's get right into it. So what exactly is this equity method? Well, it's used to account for a parent company's investment within another company, i.e. the subsidiary. Now, when exactly to use this equity method? Well, the parent needs to be able to exercise significant influence within that sub. So this can be achieved in a couple of different ways. The first being the parent is the largest shareholder within that subsidiary, or number two, they represent a majority on the board. Now, typically exam questions will just give you they purchase a 20% to 50% voting stock within that sub. Once they give you that, you kind of know you're using the equity method. But again, don't get tripped up. If they say they only purchase, say, a 10 to 15% voting stock within that sub, as long as they give you they're able to exercise significant influence, you know you're using the equity method. Now, when not to use the equity method, of course, if you're not able to exercise significant influence, or say the subsidiary is filing for bankruptcy, investment within that subsidiary is only temporary, or another group has majority ownership within that subsidiary, i.e. they're the ones who can exercise significant influence, you would not use the equity method. So that being said, let's look at some of the journal entries you're going to need to know that involve this equity method. So the first one being to account for the initial investment. You're going to raise the investment in that subsidiary account. So you would debit investment in sub, and you would credit cash if you're purchasing that investment for cash, or credit common stock and additional paid-in capital if you're issuing stock to make that investment. Next, you're going to want to account for the sub's net income, or the parent company's portion thereof. You're going to raise the investment account and raise the income account. So you would debit investment in sub to raise that account, and you would credit investment income account to raise that account as well. Next, to account for the sub's dividends paid, you're going to want to debit cash because you're receiving a portion of those dividends that they're paying out. However, the subsidiary's dividends paid would ultimately lower your investment in the subsidiary account, so you would credit that. Next, to account for excess depreciation amortization, which all that is basically when the fair value of the net assets of a subsidiary is in excess of their book value net assets, then you want the parent company to account for their portion of that excess depreciation or amortization. And this ultimately lowers your investment account as well as lowers your income account. So you're going to debit your investment income account, lowering that, and you're going to credit your investment account, investment in sub, lowering that as well. As long as you remember these journal entries, you should be good to answer majority of questions involving the equity method. So with that, let's jump into our first example here, a very simple equity method problem. So the problem on January 1, year 1, a company acquired a 30% interest in B company for $250,000. A company will be able to exercise significant influence. On this date, B company's net assets had a book value equal to their fair value of $600,000. Now during year 1, B company had net income of $75,000 and paid a dividend of $30,000. So let's see what it's asking us to calculate. Journal entry to record the initial investment in B company, amount of goodwill related to this investment, and journal entries to record A company's share of B company's net income and paid dividend. So let's take a look at this first one here. Journal entry to record the initial investment in B company. Well, it should always give you this in the problem. It will always say they acquire a certain ownership interest, which in this case is 30%, and the amount they acquired that for, interest in B company, for $250,000. So right off the bat, you know what the initial investment is. So let's take a look at our solution here. So the journal entry to record that initial investment, again, is debiting your investment account, investment in B, raising that account. And you're going to credit cash because it said they purchased it with cash of $250,000, so you would credit that. Next, let's take a look how to calculate the amount of goodwill that's related to this investment. All you're going to want to do is take a look at the fair value of the subsidiary's net assets. So it says on this date, B company's net assets had a book value equal to their fair value of $600,000. Now what you're going to want to do is find out how much a 30% ownership interest within this company should cost based on the fair value of their net assets. So if we take a look at the solution here, of course we record the fair value of the net assets, which is given in the problem at $600,000, the ownership percentage that was acquired, which is 30%, and we get $180,000. This means to purchase a 30% ownership within B company, it should only cost $180,000. However, as we know, our initial investment was $250,000. So all we're going to do is take our initial investment of $250,000, subtract out what a 30% interest should cost at $180,000, and that excess of $70,000 is allocated to goodwill. Finally, let's take a look at the last question here, journal entries to record A company's share of B company's net income and paid dividend. Well, in the question, it gives us that B company had net income of $75,000 and paid a dividend of $30,000. So all A company is going to want to do is recognize their ownership interest of 30% within this net income and within the paid dividend. So again, let's take a look at our solution slide here. We're going to record B company's net income at $75,000 and only multiply it by the ownership percentage that A company has in B company at 30%. And of course, we get A company's share of that at $22,500. Now, all you need to do with questions like these, again, is remember the journal entries. So we know the journal entry to record the share of net income, raises our investment account for $22,500, and ultimately raises our income account, so investment income credit of $22,500. Next, we're going to do the same exact thing for the paid dividend. We're going to take the paid dividend of $30,000 and multiply it by A company's interest of 30%, and we get A company's share of that dividend at $9,000. Again, this just comes down to remembering journal entries, so we're going to debit cash $9,000 because A company will receive a portion of that dividend. However, subsidiary paid dividends lower the investment accounts, so we're going to credit investment in B company $9,000. This is a very simple equity method problem. You'll see a lot of these type of questions asked, say, on your exams or on homework assignments and things like that. Moving on to the next example here, we're going to take a look at what if there's a fair value difference. So reading the problem, on January 1, year 1, C company acquired a 35% interest in D company by issuing 20,000 shares of $10 par value common stock with a fair value of $300,000. So on this date, D company's net assets had a book value of $720,000 and a fair value of $800,000. This difference was attributed to equipment with a remaining useful life of 7 years. Now, during year 1, D company had net income of $100,000 and paid a dividend of $40,000. So let's see what it's asking us to calculate. The first being journal entries to record the initial investment in D company, C company's share of D company's net income, and pay dividend. So it's exactly what it asked us in the first example. However, now it also asks us the journal entry to record the depreciation of the fair value difference of equipment and to determine the ending balance for the investment in D company amount and the investment income amount. So taking a look at the first question here, we're going to do exactly what we did in example 1. We're going to find out the ownership interest that they purchased, which is 35%, and we're going to find the fair value of that investment, which is $300,000. However, notice in this problem that we're issuing stock to make this investment, so we're issuing 20,000 shares at $10 par. So if we take a look at our solution here, we're going to debit and raise the investment in D company because we're purchasing at 35% interest at fair value of $300,000. However, we issued 20,000 shares at $10 par, so we're issuing common stock for $200,000, and anything in excess, as we know, goes to additional paid-in capital at $100,000. Next, to account for the share of net income and dividends, we're going to take a look at D company's net income, which here it says $100,000, and their paid dividend of $40,000. So again, taking a look at the solution, we're going to take D company's net income of $100,000, multiply that by the ownership percentage that C company purchased at 35%, and that gives us C company's share at $35,000. Again, this is just remembering journal entries at this point. To record the share of net income, we're going to raise the investment account, investment in D company, by $35,000, and we're going to raise the investment income account by $35,000 as well. And to record the paid dividend, we're going to take D company's dividend at $40,000, multiply that by the ownership interest at 35%, and get C company's share of that dividend paid, $14,000. So we're going to debit cash $14,000 because we're receiving some of that dividend. However, a subsidiary's dividend ultimately lowers the investment account, so we're going to credit investment in D company at $14,000. Next, let's take a look at our second question here. Journal entry to record the depreciation of the fair value difference of equipment. So in the question, it does give us that the net asset of the sub has a book value of $720,000. However, it has a fair value of $800,000. So we need to find that difference. So if we take a look at the solution, the fair value of net assets given in the problem is $800,000, and we're going to find the difference between the book value of net assets at $720,000, which leaves us a fair value difference of $80,000. However, we need to remember we're not using that full fair value difference. Again, we're multiplying that by the ownership percentage that C company has within D company, which is 35%. So the fair value difference of $80,000 multiplied the ownership percentage of 35%, we get $28,000, which again is C company's share of that depreciation. Now, also in the problem, it says that this difference was attributed to equipment, and it has a remaining useful life of 7 years. So the amount of depreciation that we're going to record is C company's share of depreciation of $28,000 divided by the remaining useful life of that equipment of 7 years, and we get $4,000 for the depreciation per year. Now, again, going back, this is remembering journal entries. We know the depreciation, or C company's share thereof, lowers the income account and lowers the investment account. So we're going to debit investment income of $4,000, and we're going to credit investment in D company of $4,000. Finally, let's take a look at the last question. Determine the ending balance for the investment in D company amount and investment income amount. This all comes down to, again, just remembering journal entries. As long as you know how to do the journal entries, you'll know how to calculate these balances. For example, the initial investment raises the investment in D company $300,000. The portion of net income will raise the investment in D company account. However, paid dividends will lower the investment in D company account, $14,000. And the portion of depreciation will lower the investment in D company amount by $4,000 as well. Also, the income account, net income, will raise the income account by $35,000. However, the depreciation will lower the income account by $4,000. So if we take a look at that solution here, again, the initial investment raises it $300,000. C company share of net income raises it $35,000. C company share of the dividend lowers it $14,000, and the depreciation per year lowers that $4,000. So we get an ending balance of our investment account at $317,000. Again, for the income account, the C company's share of net income would raise it by $35,000. However, their proportion of depreciation would lower by $4,000, so we get an investment income balance of $31,000. So this problem a little bit more tricky, but again, as long as you understand the journal entries and you know how to apply them to solve for these questions, it shouldn't be any trouble. Finally, taking a look at our third example here, having to do with impairment loss. Reading the problem, Z company owns a 25% interest in X company, making them the largest shareholder within the company. At the end of the first year, Z company's financial statements displayed a carrying value of $2 million for the investment in X company. During the following year, X company reported a net loss of $20,000. So at the close of this year, Z company's management estimated the fair value of its investment within X company to be $1,500,000, which is considered to be other than temporary. So now it wants us to calculate the impairment loss to be reported at the end of the following year. Well, first we have to find our carrying value and compare that to our fair value to find that impairment loss. So if we take our carrying value at the end of the year and then recognize X company's net loss of $20,000, again, we're going to have to find Z company's 25% interest within that net loss. So taking a look at our solution here, X company's net income, which is a $20,000 loss, multiply that by the ownership interest within X company, which is 25%. Z company's share of that would be $5,000. So we're going to take our initial carrying value of $2 million, subtract out that $5,000 Z company's share of their X company's net income, $5,000. We get Z company's carrying value at the end of the second year at $1,995,000. Next, we're going to want to take this carrying value and compare it to the fair value, which it says Z company's management estimated the fair value of its investment within X company to only be $1,500,000. And as we know, when the fair value of an investment is below the carrying value, we record that as the impairment loss. So again, the carrying value of Z company of $1,995,000, finding the difference between the fair value at $1,500,000, we know we have an impairment loss of $495,000. Now just remember, this impairment loss would be recognized within the income statement of Z company in their financial statements at the end of the year. So that pretty much goes over everything you could be asked when using the equity method. Just remember the journal entries. As long as you know how to record the journal entries and you know how to solve for the journal entries, you can pretty much answer everything having to do with the equity method. So what I like to do is leave a question at the end of each video. This one being, what amount of goodwill is related to C company's investment into D company in example 2. Now we went over how to calculate goodwill in example 1, but if you can figure out how to solve for it in example 2, leave it in the comments below. I'll pin the first comment that I see that's correct, and also leave in the comment section below what videos I should make next or other topics that you want me to go over. That being said, I hope you enjoyed the video and everyone have a good one.